Real estate taxes explained. SALT cap, deductions and home sale exemption clapperboard intro. Hook plus joke 30 seconds. Let's talk about real estate taxes. Because nothing says, home sweet home, like arguing with the IRS. If you live in a high tax state, you probably know the pain of the SALT cap. For years, it felt like the IRS said, you can deduct your property taxes, but not really. Good news. The SALT cap has changed for 2025. And today I'll explain exactly what that means, along with what's deductible when you own a home, what's not deductible, and how you can legally exclude up to $250,000 or $500,000 of gain when you sell your primary residence. House Part 1. What's deductible when you own a home? Checkmark Keycap 1 Mortgage interest. If you itemize deductions, you can deduct mortgage interest on acquisition debt up to $750,000 for loans taken after 2017. This applies to your primary residence, and possibly a second home. But remember, you must itemize. If you take the standard deduction, you don't separately deduct mortgage interest. Checkmark Keycap 2 Property taxes. The SALT cap update, 2025 to 2029. Here's the big update. Under the 2017 tax law, the SALT deduction was capped at $10,000 per year total, property taxes plus state income taxes combined. But starting in 2025, the cap increases to $40,000 for most taxpayers, $20,000 if married. Filing separately. This higher cap runs from 2025 through 2029. Warning: income phase out. However, the expanded cap begins to phase out if your income is high. Phase out starts at about $500,000 of Magi. Married filing jointly, fully phases down back to $10,000 at roughly $600,000 of Magi. So if you're above that level, you're essentially back to the old $10,000 cap. The limits are indexed slightly for inflation each year. And unless Congress extends it, in 2030 the cap reverts to $10,000. Checkmark Keycap 3 Home office. If self-employed. If you are self-employed and use part of your home exclusively regularly for business, you may deduct a portion of utilities, mortgage interest, insurance, depreciation, but this only applies to legitimate business use, not your kitchen table. Sometimes. Crossmark what's not deductible. For your personal residence, you generally cannot deduct homeowners insurance, WA fees, utilities, landscaping repairs and maintenance. Those are considered personal living expenses. Home Part 2. Selling your home. The $250,000 per $500,000 exclusion. Now let's talk about the big tax break. When you sell your primary residence, you may exclude $250,000 of gain if single, $500,000 of gain if married. Filing jointly. This is one of the most powerful tax benefits available to individuals. Pushpin requirements. Section 121 rules. You must meet 2 tests. Keycap 1 ownership test. You owned the home for at least 2 years. Keycap 2 use test. You lived in the home as your primary residence for at least 2 of the last 5 years before the sale. Important notes. The 2 years do not have to be continuous. You can use this exclusion once every 2 years. Money bag example: you bought your home for $500,000. You sell it for $900,000. Your gain equals $400,000. If single, first $250,000 equals tax-free, remaining $150,000 equals taxed as long-term capital gain. If married, filing jointly, entire $400,000 equals tax-free. That's potentially zero federal tax on a very large profit. Upward trend. What if your gain exceeds the exclusion? Any excess is taxed as long-term capital gain, assuming you owned the home more than 1 year. Rates are typically depending on your tax bracket. See our video about long-term versus short-term capital gains. High earners may also owe the 3.8% net investment income tax. Open folder pro tip. Increase your basis, keep records of major improvements. New roof, kitchen remodel, additions, structural upgrades, improvements. Increase your cost basis. which reduces your taxable gain. Repairs do not increase basis. Bullseye quick recap checkmark mortgage interest may be deductible checkmark SALT cap increases to $40,000, 2025 to 2029. But phases out at high income cross-mark personal home expenses aren't deductible. House you can exclude $250,000 or $500,000 on sale of your primary residence. Upward trend excess gain is taxed as capital gain. Real estate tax rules can save you tens, even hundreds, of thousands of dollars if you understand them. If you found this helpful, like and subscribe, and comment below if you want a breakdown of rental property taxes next.